If you're looking for quality stocks to put in your tax-free savings account, there are some excellent options to consider right now. A TFSA is a great place for dividend stocks because the dividend income they generate inside there is completely tax-free, even when you withdraw the money out. It's a great way to build up your portfolio over time and generate some recurring cash flow. Whether you want to reinvest the dividends to grow your portfolio even faster, or you just want some extra cash on a regular basis to pay bills or anything else, dividend stocks can be extremely powerful investments to own, as you don't need to sell them to generate cash. The three stocks I'm going to talk about in this video are some of the best dividend investments on the TSX. Not only do they offer high yields, but they're also safe investments to hang on to. Their payouts are safe, they've been growing their dividends for more than a decade, and they aren't volatile. They could potentially be among the safer options to be holding in a downturn as well. Here's my list in order from lowest yield to highest yield. Fortis. Fortis owns one of the longest dividend growth streaks on the entire TSX at 51 consecutive years. It has consistently raised its payout even when economic conditions haven't been all that great. It's a testament to the strength and stability of its business. The utility provider is a leader in the industry, and it benefits from relatively stable and predictable financial results. In each of the past years, for example, its revenue has been around $11 billion, and its net income has been at least $1.3 billion during that stretch. The company has a lot of confidence in its financials and future growth, and it believes that with continued growth and expansion, it will be able to raise its dividend at least until 2029 at an annual rate between 4 and 6%. That doesn't mean the dividend increase will stop after then. In fact, they probably won't. But the company is just offering guidance as far as it can. In all likelihood, Fortis is going to remain a top dividend growth stock for many years beyond that. It currently yields 3.5%, which is a solid rate when you consider that the S&P 500 average is only 1.2%. But on a list full of top dividend stocks, the yield is still the lowest on this list. Another reason you'll want to consider owning the stock is that it's not volatile. It has averaged a beta of just 0.35, which means that while the stock market may go on wild swings sometimes, Fortis remains fairly stable. That doesn't mean it won't decline in value, but it'll be safer than just going with the overall market. A good example is 2022, when the markets crashed due to inflation. That year, the S&P 500 declined by 18% when including dividends, but by comparison, Fortis's total returns were a negative 14%. It was a bit lighter, but it's important to also have realistic expectations. The stock was down as well, but it wasn't as bad as the overall market. Next up is a much higher yielding stock, Enbridge. The pipeline company pays 5.8%, and it gives investors a huge incentive right away to hang on to it. This high of a yield may normally seem too good to be true, and it can be a sign that a stock is risky, but that isn't the case with Enbridge. The company relies on long-term contracts, and thus its operations are usually fairly stable and consistent. And that's notable with its ability to continually meet its financial guidance. The company says that this year it's on track to hit its financial guidance for a 20th consecutive year. That's an impressive track record that's hard to beat. And with that guidance, investors get a lot of confidence in the company's ability to mean what they say and for minimal surprises to come up along the way. For dividend investors, that consistency is what makes this an excellent investment to consider for the long haul. Enbridge has averaged a beta of less than 0.9 over the past 5 years, which further proves that it's a dependable stock to own if you just want reliable dividend income. This year, it's up around 9%, which isn't as strong as the pace of the overall market, but it's still a decent return overall, and it doesn't factor in the dividend either. Otherwise, you'd obviously be up even more. And over the past 5 years, the stock has risen by around 80%. Another great feature about the stock is that Enbridge has also consistently raised its dividend. Its streak may not be as impressive as Fortis's, but at 30 years of making dividend increases and the company also consistently hitting its guidance, it seems highly likely this trend is going to continue in the years ahead. Enbridge is a reliable dividend stock to own, and when you consider its dividend growth, it can be a no-brainer option for the vast majority of investors. It's a solid stock to own for the long haul, and it's a perfect option inside of a TFSA. This brings me to the third stock on this list, TELUS. TELUS is a leading telecom company in Canada, and although telecom stocks haven't been hot buys of late, TELUS is still a stock you'll want to consider holding on to due to its impressive dividend. It currently yields just over 8%. Making it an incredible income-generating investment. The big question is whether that yield is truly sustainable and safe. At first glance, you might see a startling high payout ratio of more than 200% and conclude that it's too risky. But a big reason for that is the company incurred an impairment loss recently which wiped out its earnings in Q2. That impacted its net income and EPS, which is why at first glance, the dividend doesn't look safe. This can be a problem with just looking at ratios and filtering out stocks based on screeners. If you simply see a high yield and a high payout ratio, you may not bother with the stock, but that can be a mistake. When adding back goodwill impairment and other non-cash adjustments, TELUS adjusted net income was down just 7% from the previous year. The more important figure to focus on is its actual cash flow. Over the past 4 quarters, TELUS free cash flow has totaled $2.2 billion, which is more than nearly $1.6 billion it paid in cash dividends. That suggests that the dividend is still safe, even though the payout ratio, which is based on net income, may tell a different story. It's important to consider the context and why TELUS's numbers don't look so good. The reality is, the dividend is not nearly as risky as it appears to be. Over the years, TELUS has been increasing its dividend and it plans to continue to do so in the future. You can see that its goal is for its dividend to be within 60 to 75% of free cash flow, and $1.6 billion is just under 73%. So for TELUS's management, the dividend shouldn't be a concern as it falls right within that range. Its goal is to raise its dividend between 3 to 8% until the end of 2028. But even with modest increases, this can already make for a great buy because with an 8% yield, you're already getting a ton of dividend income from the stock today. This year, TELUS is up 7%, although in the past 5, it has declined by 9%. Telecom stocks haven't been hot buys because of high fixed costs and rising interest rates that can make them look risky in comparison to other stocks. But as investors look for safe stocks to own, especially if economic conditions worsen, a stock like TELUS, which offers a massive yield, could become a hotter buy in the future. Its beta is also less than 0.9, as this should remain a relatively stable investment to buy and hold for the long term. It looks expensive as its PE multiple is over 33, but remember, a recent quarter is weighing on its earnings because of an impairment charge. On a forward earnings basis, which factors in how analysts think the stock will do over the coming year, the forward PE is much lower, right around 20. TELUS isn't as risky or expensive as it may look to be, and right now, it may be one of the best, if not the best overall dividend stock you can find on the TSX. That rounds out this list of what I think are the 3 best dividend stocks on the TSX. What do you think, and do you own any of them, or do you have any others that you think are better? Let me know in the comments. Thanks for watching, and please be sure to leave a like and subscribe for more of these types of videos.